Stocks are like tiny pieces of big companies. When you hear about stocks, think of them as small portions of a larger entity. Each stock represents a fraction of ownership in a company, giving you a stake in its future. Imagine a giant pizza cut into thousands of slices. Each slice represents a share of the company. Just as each slice is a part of the whole pizza, each share is a part of the entire company. This analogy helps to visualize how stocks work. When you buy stock, you buy a slice of that pizza, owning a small part of the company. This means you have a claim on a portion of the company's assets and earnings. Essentially, you become a part owner of the business. This ownership is represented by shares. Each share is a unit of ownership, and the more shares you own, the larger your stake in the company. Shares are often traded on stock exchanges where investors buy and sell them. Companies sell these shares to raise money. This process is known as an initial public offering, IPO. By selling shares, companies can obtain the capital they need to fund their operations, invest in new projects, and drive growth. They use this money to grow their business, develop new products, or expand into new markets. The funds raised from selling shares can be used for various purposes, such as building new facilities, hiring more employees, or conducting research and development. As a shareholder, you become a part owner, participating in the company's success. When the company performs well, the value of your shares can increase, leading to potential financial gains. Shareholders may also receive dividends, which are a portion of the company's profits distributed to investors. The more shares you own, the bigger your slice of the pizza and the greater your ownership stake in the company. This means you have a larger claim on the company's assets and earnings, and you may have more influence in company decisions. As the company grows and becomes more valuable, the value of your shares also increases. This appreciation in share value can lead to significant returns on your investment over time. Investing in stocks can be a way to build wealth and achieve financial goals. Investing in stocks allows you to participate in the growth of the companies you believe in, potentially growing your wealth over time. By carefully selecting companies with strong growth potential, you can benefit from their success and contribute to their journey. Remember, investing in stocks carries risks, and it's important to do thorough research and consider your financial goals before making investment decisions. There are two main types of stock, common and preferred. These two categories form the backbone of equity investments, and understanding their differences is crucial for any investor. Think of them as two different flavors of ice cream. Just as you might have a preference for one flavor over another, investors often have a preference for one type of stock based on their financial goals and risk tolerance. Common stock is like vanilla, the classic choice. It's the most widely held type of stock and represents a basic ownership stake in a company. It gives you voting rights in company decisions, such as electing the board of directors. This means you have a say in the strategic direction of the company, which can be quite empowering for shareholders. You also get a share of the company's profits through dividends if the company pays them. Dividends are typically paid out quarterly and can provide a steady income stream, which is particularly attractive to income-focused investors. Preferred stock is more like chocolate. It has some extra perks. While it might not be as common as vanilla, it offers unique benefits that can be appealing to certain investors. Preferred stockholders usually don't get voting rights. This means they don't have a direct say in the company's management or strategic decisions. However, they receive priority when it comes to dividends. This means that preferred stockholders are paid dividends before common stockholders, providing a more predictable income stream. They are first in line to receive a fixed dividend payment, even before common stockholders. This fixed dividend can be particularly attractive during times of economic uncertainty, as it provides a level of income stability. Both types of stock represent ownership in a company, but they come with different rights and potential returns. Common stockholders may benefit from capital appreciation if the company's stock price increases, while preferred stockholders enjoy more stable dividend payments. It's important to understand the differences to determine which type aligns better with your investment goals. Whether you prioritize having a voice in company decisions or prefer a steady income from dividends, knowing the characteristics of each type of stock can help you make more informed investment choices. Additionally, the choice between common and preferred stock can also depend on your investment horizon and risk tolerance. Common stocks are generally more volatile and can offer higher returns, but they also come with higher risk. Preferred stocks, on the other hand, tend to be less volatile and provide more consistent returns. making them suitable for conservative investors. Consulting with a financial advisor can also be beneficial in making this decision. They can provide personalized advice based on your financial situation, helping you to build a diversified portfolio that includes the right mix of common and preferred stocks. Remember, both common and preferred stocks have their own advantages and disadvantages. By understanding these, you can better navigate the stock market and make investment choices that align with your financial goals and risk appetite. Imagine a lemonade stand wanting to expand and sell more lemonade. They need money to buy more lemons, sugar, and maybe even hire some help. So they decide to sell shares of their lemonade stand to the public. This is similar to what companies do when they go public through an initial public offering or IPO. It's like opening up their lemonade stand to investors like you. Companies go public for several reasons. Primarily, they want to raise capital to fuel their growth plans. This capital can be used for research, expansion, or paying off debt. IPOs also allow early investors and company founders to sell some of their shares. This allows them to cash in on their investment and realize their profits. Ever wonder how the price of a stock is determined? It's a question that intrigues many, from seasoned investors to curious newcomers. The stock market can seem like a mysterious place, but at its core, it's driven by basic economic principles. It's like a bustling marketplace, with buyers and sellers constantly interacting. Imagine a busy bazaar where traders shout out prices, haggle, and make deals. The stock market operates in a similar way, but on a much larger and more complex scale. The price of a stock fluctuates based on supply and demand. When demand for a stock is high, its price rises. Conversely, when demand is low, the price falls. This dynamic is influenced by a myriad of factors, both tangible and intangible. If more people want to buy a stock than sell it, the price goes up. This can happen for various reasons, such as positive news about the company, strong earnings reports, or favorable industry trends. Investors are always on the lookout for opportunities to maximize their returns. Conversely, if more people want to sell than buy, the price goes down. Negative news, disappointing earnings, or adverse industry developments can trigger a sell-off. The market's reaction to news can be swift and sometimes unpredictable. Several factors influence investor sentiment and ultimately stock prices. These include company performance, industry trends, and broader economic conditions. Let's delve into each of these factors to understand their impact. A company's earnings, profits, and overall financial health play a significant role. Investors closely monitor quarterly earnings reports, looking for signs of growth or potential red flags. A strong earnings report can boost investor confidence and drive the stock price up. Positive news can drive the price up, while negative news can send it down. For instance, a breakthrough product launch or a successful merger can lead to a surge in stock price. On the other hand, scandals, lawsuits, or poor management decisions can have the opposite effect. Industry trends factors affecting the overall industry, such as new regulations or technological advancements, can impact stock prices. For example, a new government policy favoring renewable energy can boost stocks in that sector, while stricter regulations on pharmaceuticals might negatively impact drug companies. Economic conditions. The overall health of the economy, interest rates, and inflation can also influence investor sentiment and stock prices. During times of economic growth, stocks generally perform well as companies expand and profits increase. Conversely, during economic downturns, stock prices may fall as businesses struggle and consumer spending declines. Understanding these dynamics can help investors make informed decisions and navigate the complexities of the stock market. Ready to dive deeper into the world of stock investing? Subscribe to our channel and hit the notification bell to stay updated with our latest videos. Your journey to becoming a savvy investor starts here. Section 5, Brokerage 101, your gateway to the stock market. To buy and sell stocks, you need a brokerage account. Think of it as your online store for stocks. There are many brokerage platforms available, each with its own fees, features, and investment options. Some popular choices include full-service brokers, which offer a wide range of services including financial advice and research, but they usually charge higher fees. Discount brokers provide a more DIY approach with lower fees, but they offer limited advice and research. Robo-advisors use algorithms to manage your investments based on your risk tolerance and financial goals. When choosing a brokerage account, consider your investment goals, experience level, and how much guidance you need. However, starting small, dreaming big initial investment. You don't need a fortune to start investing in the stock market. The amount you need to begin varies depending on the brokerage and the stocks you want to buy. Some platforms allow you to start with as little as $1. Others may have minimum deposit requirements, typically ranging from $500 to $1,000. The key is to start small and gradually increase your investment as you gain more experience and confidence. Remember, investing involves risk, so only invest what you can afford to lose. Moreover, the long game, reaping the rewards of patience. Investing in the stock market is a marathon, not a sprint. The real power of investing lies in long-term growth and the magic of compounding. Compounding is like earning interest on your interest. As your investments grow, the earnings are reinvested, generating even more earnings over time. This snowball effect can lead to significant wealth accumulation over the long run. Consider this. If you had invested $10,000 in the S&P 500 index in 1990, your investment would be worth over $100,000 today, despite market fluctuations along the way. Therefore, dive in. Learning by doing in the stock market. The best way to learn about the stock market is to dive in and get some real-world experience. Start by researching companies you find interesting or believe in. Analyze their financial performance and understand their business model. Consider starting with a small amount of money that you're comfortable potentially losing. This will allow you to learn from your mistakes and gain valuable experience without risking significant capital. Remember, investing is a continuous learning process. Stay informed, adapt to market changes, and never stop learning.